Hello everyone, welcome back to All Financial Discussion channel. For this video, I'd like to discuss the difference between dollar cost averaging, which is also known as DCA, versus buying the dips. Okay, so basically this is actually one of the most popular way that we actually will adopt when we actually do some form of investment. So this video, I will explain both the advantage and also the disadvantage of these two methods, and hopefully from here, you will be able to determine which method is actually more effective for you. Basically, all this will be the objective of this video. For me personally, I will actually adopt the hybrid mode. Hybrid simply means that a combination of dollar cost averaging and also buying the dip. So therefore, stay tuned over here in order to receive more information from this hybrid mode of investment. Before I continue, guys, I'd like to urge you guys to help me by like this video. Please also encourage me by subscribing to this channel and turn on your notification bell. Once again, thank you so much for strong support. We, as a retailer investor, we always ask ourselves this fundamental question. Should we try to time the market? What does this time the market means? We know that if we are able to buy low and sell high, then we are able to have some substantial of profit. However, okay, I think the time to really determine the lowest and also the highest is always very challenging, even for those who have all the information. So basically, over this method here, when we actually time the market, this is actually buy the dip because we need to know when will be the low, then we can actually buy. So this is the first method, which is buy the dip. Another method is to invest consistently, regardless of the market condition, which means that whether is it a bull market or whether is it a bear market, we still discipline, okay, consistently buy, which is the method of dollar cost average. So basically, like I mentioned earlier on, this will be the two methods that we're going to discuss for this video. When we actually choose between DCA and buying the dips, okay, so why the best strategize is in fact depend on very personal. Firstly, what kind of risk are you able to tolerate? Okay, so are you a high risk taker? Second, what kind of information you have, how much you know about the market situation. So this will be classified under market knowledge. And then next will be the investment goal. What kind of objective that you actually want, okay, when you actually invest. So basically with all these, then you probably have a choice which of them you will probably choose. Okay, so in short, like I mentioned, we will do a comparison of these two methods. Let's take a look on this graph. Okay, so this graph is basically time versus the price of the Bitcoin. Okay, so from here you can see that I have successfully identified the dip. Okay, so this will be easy when I actually has the whole graph. But when I don't have the whole graph, it may be very difficult for me to identify the dip. For example, I may be buying along this line here, okay, because I'm not able to identify the lowest point. So therefore, I may be buying along the line rather than at the lowest point. But however, this method of buying is actually called a buy the dip method. So basically from here you can see that I may buying along the line, but where exactly I may not be able to foresee when I actually don't see the whole graph. With the whole graph, I think this is quite obvious where to buy and where to sell. Another method is DCR, okay, dollar cost average. Sorry, DCA, dollar cost average. So all the blue dots here are all the dollar cost average here. So what happened here is basically you can see that every month I will make two purchase consistently and without fear. Every month I'll just buy two times. Okay, so basically from here you can imagine that if the trend is upward, then I will have some form of profit. If the trend is actually downward, then I will suffer risk. And then over here, you can see that these are probably the wrong so-called buying because they are considered quite high. And this is probably the one of the best time to buy, okay, because they are actually low in terms of price. So basically for dollar cost average, basically I will have an average number. Okay, so basically you will have the wrong buy and you also have the good buy. And then by average them together, you probably have some average point. And again, like I mentioned, if this trend is going up, then you will be pretty sure that you are going to have a profit in the future. So hence, this dollar cost average is probably for the long-term investment. Okay, let me focus on the dollar cost averaging first. Okay, what is actually dollar cost averaging? Okay, so in short, okay, dollar cost averaging is you invest a fixed, so the keyword is you need to invest a fixed amount and also at a regular interval. Okay, so in short, it can be like $500 per month, $200 per week, etc. So from here, you can see that I have a fixed amount of money to invest and also a fixed so-called time to invest. So regardless of the market condition, I basically just buy according to my plan. What is the pro of DCA? Firstly, I think one of the most important is we remove away the emotion. Okay, so emotion is actually a key part when we actually do some form of investment. Okay, for example, it can be bear market, okay, or a so-called a good market or a greed market or the fear market. So basically, if we do DCA, we actually effectively reduce all the emotion, which means that we never put any form of emotion when we actually do investment. Next will be on the timing risk. As I shared with you on the previous slide, it is almost very difficult to time the lowest or time the highest. So therefore, when we do DCA, we actually remove away the timing risk that we're going to so-called adopt when we actually use the other method. Next, okay, so this will actually smoothen out the volatility. Okay, so when we actually buy at different price level, as I described on the previous page, when we actually buy, okay, let's say 1 year, every week I'm going to buy one purchase, and basically from there, I have different price level. Some can be very high, some can be very low. But once I average up, this in fact will smooth up the volatility. And like I mentioned earlier on, if the price is going to go north, then I will definitely have some form of profit. For DCA, it's actually work well for long-term investor. Okay, for example, if you plan to do some form of retirement account, so DCA probably will be one of the best method to adopt. Next will be on the lower so-called stress when you actually invest using DCA because you have no worry regards on the market. Whether is it bear market, you don't have any worry. You just invest according to time. So hence, you probably don't have so much stress when you actually look at the outcome of the investment. And also, most important, it require very little knowledge. Okay, so hence this method is actually benefit for those newcomer. Okay, so basically you don't need to know when to buy, but rather than that, you fix a time to buy. So basically all these are the pro of dollar cost averaging. Next will be on the cons. Okay, what will be the disadvantage of DCA? Firstly, okay, it may underperform okay, in strong bull market. Okay, so in a bull market, okay, so this DCA probably will not be very useful. Okay, since we do not maximize the dip. So basically, if you are able to know the dip, okay, let's say at the dip, when you purchase the most at the dip, then you will have a chances to have a higher profit. Okay, so basically this is the con when we actually invest using DCA. Next, it does not take the advantage of major market correction. So basically, once we have V-shaped recovery, okay, we are not able to buy under the so-called V-shaped recovery, then we will not be able to take the advantage of this market correction. Okay, so basically these are all the disadvantage of dollar cost averaging. So in short, dollar cost averaging will be best for passive investor. Okay, so let's say if you plan to go for long term, okay, you don't want to do much on your investment. So basically DCA will be the best method. Also good for beginner because you don't need to know the market so well. You just went into at the correct time, same time. So basically it will be good for the beginner or those who actually prefer consistent over market timing. Okay, so basically this is for DCA. Guys, before I continue, I urge you to help me by like this video. If you have learned something from this video, please consider to subscribe and turn on your notification bell. Once again, thank you so much for strong support. Next, I'd like to discuss on the buying the dips. Okay, what is actually buying the dips? We will wait for the price drop before we start to invest in a lump sum. Okay, so what will be the pro when we actually buy the dips? Okay, so this can lead to higher returns, okay, if we are able to time correctly. So like I mentioned earlier on, if we are going to buy the lowest, okay, then if we are able to time this, then we are going to anticipate a higher return. Okay, so this buying the dips also work well in a volatilities or a bear market. Okay, because once it reaches at a certain low level here, and if you buy it and then it recover, then you will have some form of profit. Okay, so this is actually more capital efficient if you catch the major pullback. Okay, so this is what I mentioned. Okay, basically on the on the DCA. For example, okay, if this is a major pullback, okay, and if you are able to catch the lowest, then you will have some form of profits. Coming to the cons, the disadvantage of buying the dip. Okay, so basically this require, okay, a lot of market understanding, and you need to be emotion discipline. Okay, for example, as I mentioned earlier on, you probably need to be able to identify, okay, or maybe not exactly at the lowest or the highest, but you need to be pretty close to the lowest and the highest. So therefore, with this kind of skill, you require to have some form of market understanding. Next, okay, when we actually do some form of or so-called investment, okay, definitely emotion come into play. Okay, because there will be fear, there will be greed, and hopefully if you are able to remove all this emotion, then you will be able to adapt this buying the dip method on the investment. So another disadvantage is you're going to have the risk of missing the gain, okay, while waiting for the dip. Okay, for example, if the price go on and on and on and on, or up all the way to the north, then you will be basically missing all the gain while you still patiently waiting for the dip, which never happened. Okay, so therefore, this is also another disadvantage when you actually apply the buying the dip. Next, okay, as I always mention this is going to be very hard to predict, okay, how far a dip will go. Okay, for example, 5%, 10%, or 15% or 20%. This thing can go on and on. So without seeing the graph, it is almost very challenging to identify the lowest point. So in short, buying the dip will be best for experienced investor. Okay, so I have not reached this level yet. So therefore, for me, probably hybrid will be more effective. I honestly have not come into an experienced investor at this moment here. For active trader, because you need to monitor the market constantly. So basically, you need time, okay, when you actually monitor the market, or those with cash reserve ready to deploy. For example, if you have large amount of cash which you are ready to deploy, then you can actually consider to use this buy the dip method. Okay, so next, which strategize actually work best? Okay, so basically, as I mentioned here, DCA will be best, okay, for most investor, okay, because it is very simple and you just need to have some discipline and you need to avoid all the pitfall of market timing. Okay, so basically, this is basically work best for anybody that does not understand the market fully. DCA will be better. So buying the dips can actually outperform, okay, but definitely it requires some form of skill, some form of patience, and also you need to tolerate some form of risk. Okay, because the low may not be continue low, and basically you must be able to tolerate this kind of risk. Okay, so for me, as I mentioned here, okay, I will be basically using this hybrid approach. Okay, so some investors actually combine both DCA regularly, but also so-called deploy the extra cash during the big market dip. For me personally, okay, I will do DCA. For example, let's say if you have this $1,000 to go for DCA, so basically you just need to put 800 to go to DCA. Another 200 will be looking for the dips. Okay, so basically this is a so-called quite useful tip to have some form of investment. So DCA about 80% of your money, 20% on your dips. Okay, so when you are more comfortable, you actually can increase the amount of dips and actually you can put lesser to DCA. So basically, since I'm still new, okay, to investment, so therefore I put majority of my investment under this DCA. 80% of my fund will be on DCA, while 20% of my fund will be looking for potential dips. Then I buy in, and then hopefully at the high time, I actually sell all this. Okay, so let's come to the final verdicts here. So if you are going to for long term, okay, for long term investment, and you probably want to have the hands-off approach, then DCA will be very useful for you. If you are very active and you are very confident that you are able to identify the low and high, then use the buy the dip. Last but not least, if unsure, not really unsure, okay, but if you have some skill, but you are not so sure that your skill is there yet, so therefore you can actually apply both the DCA and also the deep buying. Okay, so with this, I'd like to end my discussion. Please help to like this video and subscribe to this channel. Once again, Thank you so much for strong support. I hope to see you guys soon. Bye for now. Thank you so much.